Well, good morning, Governor and fellow members of the MPC. Thank you very much for coming to give evidence to us this morning. We've got quite a lot to get through, so I think we should get underway. Like the weather, the Eurozone crisis seems to have come back. Just like the weather, too, rather changeable day by day. How serious a problem is this for the UK economy and for conduct of monetary policy?
Well, Chair, it is a serious issue. It's our largest trading partner, our largest investment destination. The challenges that are currently facing Greece are material for the Greek economy. Now, the Greek economy itself is not that important for UK exporters. The exposure of the UK financial system is quite small to the Greek economy. For example, for the major UK banks, the exposures are less than 2% of common equity.
It's a contagious crisis.
So the issues are more about other channels of contagion, not direct channels of contagion, as you indicate. Implications for confidence in the Eurozone as a whole, potential financial market contagion. Now, the situation today is quite different than it was in 2012, the last time the weather or the Eurozone crisis was with us, in that there are quite distinct differences in the track records of the other so-called peripheral economies, Ireland, Portugal, Spain, and superior track records in terms of performance relative to Greece. They're off program. Secondly, the tools of the ECB, toolkit of the ECB has been enhanced both with quantitative easing and with open market transactions. And there's a demonstrated willingness of the ECB to use those tools. In fact, a unanimity of the ECB with respect to quantitative easing, so that makes a difference as well. In addition, the exposure of the private sector as a whole, I'm not talking about the UK private sector, but the private sector as a whole, to Greece has been substantially reduced. For example, for sovereign exposures, only 20% of that exposure to the Greek sovereign is to the private sector. So there are a number of differences, but as a committee, personally and as a committee, we wouldn't downplay the risks. There are risks there. If there were to be a disorderly exit of Greece, we would expect that would have ramifications for asset prices more broadly, and potentially for confidence, and then that those improvements in the institutional structure in the euro area would need to be used to reduce that.
You've talked about a disorderly exit. Can the Greek economy recover at current exchange rates?
Can the Greek? Yes. The question of the strength of the recovery, and that will be a product, not least in terms of how diligently and comprehensively and quickly the Greek authorities implement the reform package that they're in the process of agreeing with the European authorities.
Okay. Other colleagues might come back to Greece in a moment. It's an important issue. But a key document in front of us today is the inflation report. And I suppose the first question I ought to ask you is how long we have to run with current policy before you decide that it needs to be called the deflation report. How serious is this, that we are now running into a period at least where we're going to have prices falling? And do you think that we should think of being below target as exactly symmetrical with being above target in potential level of harm?
Okay, well, let me start with your last point, which is the treatment of the target. It is absolutely symmetric. We care as much about inflation being below the target as we do about having inflation above the target. And we, in treating deviations from target, we have to take an assessment of the nature of the shock. Why is inflation below target in this case? And the time horizon over which to bring inflation back to target. Now, the predominant cause of inflation being as low as it is, 0.3% on its most recent reading, are food and energy prices, principally energy prices. In fact, it was 2/3 at the time of when I wrote the letter to the Chancellor and we published the inflation report. On the most recent reading, is 3/4 of the movement relative to target is caused by food and energy prices. Those are one-off price changes, one-time fall in the oil price, one of the largest falls in the last half century, being the principal driver. We have the ability we have to make a choice, but we have the ability, as you know, to look through deviations from target, whether above or below. The committee, prior to my arrival, looked through a series of one-off shocks when inflation was above, rightly so in my judgment. I didn't take those judgments, but rightly so in my judgment, in order to not cause undue volatility in output, said differently, not cause excessive increases in unemployment at a time when the economy was very slow. We're in a situation today where we have these one-off moves in oil prices, energy prices more broadly, and food prices that are principally driving inflation down and will likely bring it further down towards zero and possibly below zero. We can look through that, provided that we do not see signs, more generalized signs.
What are the key indicators?
Okay, of more generalized disinflation or deflation. First and foremost, well, we start, given that we have
savings.
Given that we have an inflation target, the first thing we'll look at is the components of inflation. So we look at the diffusion, the various diffusion indices. Important point, when we look at the CPI components today, and it's embedded in the letter, on a weighted basis, it's exactly the same proportion of components that are above zero, so have positive inflation, as was the case during the period of 97 to 2007, so the period at which inflation was broadly at the 2% target. So we look at diffusion indices. We will look at wages and other principal causes of inflation. As you're aware, as the committee is aware, at present, average weekly earnings are growing. So real incomes are growing more strongly, actually, in this case. And the other suite of indicators that we are very vigilant at looking at are estimates of inflation expectations, both survey estimates and market estimates. And the conclusion of the committee with respect to the last...
deflationary expectations.
Well, in the short term, yes, but in the medium term and over the relevant policy horizon, the expectations are for positive inflation. And the conclusion of the committee, which I share, is that those expectations are broadly consistent with the 2% inflation target. But we will continue to be vigilant in monitoring those indicators, because those are the type of indicators which...
I want to bring in the externals at this point, see if they've got anything to want to add to this. Professor Miles.
I think the expectations story is one where over the next year expectations clearly are low. Our own expectation on the Monetary Policy Committee is that inflation is pretty close to zero for much of this year. I think beyond that, households and companies and financial market expectations of inflation look to me pretty consistent with inflation moving back to the target level. So they don't seem to me to be pointing to an expectation of ongoing deflation at all.
Dr. Weale, there's not much talk in the inflation report about the effect of a period of deflation on consumer behaviour, and in particular consumers deciding to save to buy the same goods next year, and therefore for there to be a pick-up in the savings ratio. The central forecast, in fact, is for some modest fall in the savings ratio, and for it to be considerably below where it was at the average of the previous 10 years. Are you happy with that assessment of savings?
Yes, I am broadly happy with that. I think that at least the evidence I've seen suggests that the behaviour of quite a lot of people is influenced by money interest rates at least as much as real interest rates. What people are seeing at the moment are that their cash outgoings are going down rather than up, and their feeling is that this is giving them a bit more money to spend. So I think the cash flow effects are quite important. And more generally, I think the sort of example I give, were there many people who put off visiting friends and relatives at Christmas because the petrol was going to be cheaper in January, or they thought it might be cheaper in January. So I don't think we see much evidence.
It's the wrong sort of price falls to pick up that effect, is what you're saying.
Well, yeah, indeed.
It's not white goods, it's petrol.
But even with white goods, I mean, there has been a long-term tendency of white goods to become cheaper and improve in quality and so on. Yeah. We notice that all the time, but people go on buying them.
Good. Jesse Norman.
Thank you very much indeed, Mr. Chairman. Welcome, Governor. I want to turn to Marge. I've also got a couple of earlier quick questions, if I might. Governor, can I ask if you viewed the video of the Grabiner testimony to us?
No, I have not.
You have not viewed it. Thank you for that.
I should explain for members of the public, we are having a session on this next week, so we'll be looking at it in more detail then, and you'll be coming together with the Chairman of Court.
Perhaps I could request that you look at it before our next meeting, Governor. In the bank's guide to your employment, it says that we aim to be courteous in our personal relations, both externally and internally, and in particular, you, the employee, are expected to perform your duties diligently and punctually, to behave to the public and your colleagues with courtesy and consideration. Do you think, based on the reading of the transcript, if you haven't yet seen the video, Governor, that Lord Gravener's testimony to us was up to the standards of the behaviour expected of the bank, or do you think it fell below it?
Lord Gravener was contracted by the Oversight Committee of the Court. Lord Gravener is not an employee of the Bank of England. And I would stress, again, as I pointed out in my letter to you, Mr. Norman, that Lord Gravener, as being contracted by the independent directors of court, chaired by the chair of court, Anthony Hapgood, that is the arrangement. So I'm now answering as a member of court, but not a member of the Oversight Committee. I think it's important that we make that distinction, given the amount of time and thoughtfulness and effort that this committee has spent on the governance of the bank, that we're clear about how the governance arrangements have been put into place and how independent investigations have been conducted. With that context, with the second point of context being that Lord Gravener was contracted by the Oversight Committee, he's not an employee of the Bank of England. I'm not going to venture an opinion on his conduct.
I did. Thank you, Chairman. So you don't think that the bank's standards of behaviour should extend to its public contractors, those making inquiries into it? That's what you've said.
That is not what I said. I said I wasn't going to venture a judgment.
You have a private opinion, but not one you're going to share with the committee?
I don't have a fully formed view. As I noted, I haven't viewed the video, as you pointed out.
Could I ask a question finally, which is...
In part, as I should add, Mr. Norman, in that we are having a session on this next week.
I understand. Final question, perfectly understand, which is, has Lord Gravener apologised to you or any other member of court for his behaviour in front of us?
He's not apologised to me. I've not asked for an apology from him, and I do not know what he has said to other members of court.
Thank you very much, Governor, for those comments. In your speech in Dublin recently, you said that the Eurozone needed a plan that, quote, should include what every other successful currency union has at its heart, mechanisms to share fiscal sovereignty. Now, central bankers normally think about monetary policy rather than fiscal policy, and so I'm wondering why it was you chose to make public comments, possibly criticisms of Eurozone governments on matters of fiscal policy.
Right. Well, part of the answer to that question is the first question of the chairman of this committee, which is that it is relevant to the British economy, the developments in the Eurozone. As I said, it's our largest investment destination, it's our largest trading partner. Clearly, in the judgment, including the judgment of the President of the European Central Bank, the judgment is that European Monetary Union is, and I quote, unfinished. And the question is, what is necessary to finish that monetary union? My comments in Dublin were anchored in that, answering that question. Also answering it in light of the experience in this monetary union, issues that we've discussed at this committee over the course of the last year and a half with respect to sterling monetary union. The basic point is that it's necessary to have both private and public risk-sharing mechanisms. So a banking union, the effort that has been the focus of European authorities the last several years, that's very welcome. A capital markets union, which is the new focus, also welcome and also necessary, something that would extend across the European Union, so something the UK will benefit from and we can inform. And lastly, making the point that it is necessary also to have some form of public risk sharing, as is the case in other successful currency unions, which brings into the fold fiscal arrangements. Now, to be absolutely clear, My conclusions, or my arguments in the speech, and conclusions in the speech, relate to the structure of fiscal policy, the structure of monetary union, and they're also conclusions that were the conclusions of the President of the European Central Bank, the President of the European Council, the President of the European Commission, and the President of the Eurogroup, as demonstrated in the four-president report, which I quote in that speech.
So you said in your inflation report press conference that you'd had discussions with counterparts, obviously possibly some of the people you've just mentioned, prior to the speech and subsequently to it, both in central banks and ministries. You've said they were supportive. Were there any countries or institutions that were actively keen for you to speak out on this issue from outside the Eurozone as you are?
The short answer is yes, but I'm not going to go into which ones.
I understand. That's very helpful. So there was a feeling that it would be a constructive contribution to the debate for you to flag to Eurozone governments the importance of sharing fiscal sovereignty and risk sharing of the kind you've described.
Yes, and I would say that I've received no comment to the contrary from any European authorities since the speech.
That's extremely helpful. I don't have any further questions, Chair.
Mike Kane.
Government Committee. Given that in the autumn statement the Chancellor welcomed low inflation, and given that it was below target, were you surprised by his statement now?
Well, Chancellor can speak for himself. From our perspective, what we have been at pains to stress is the causes of that very low inflation. And I'll just refer back to my previous answer with respect to the predominant causes being movements in food and energy prices. We've also been keen to stress that that is temporary. It's a one-off development. As these move through the inflation numbers, they will dissipate after a year. Thirdly, we have been at pains to stress that we will do our job as the MPC, which is to bring inflation back to the 2% inflation target, that we will do so in a reasonable horizon. The judgment of the committee, the unanimous judgment of the committee, was that that horizon, given the nature of the shocks that are hitting the economy at present, given those shocks at present, that horizon should be within the next 2 years, and that we not only have the responsibility to do that, we've now provided the clarity about the time horizon, we also have the means and very much the will in order to do that. So we recognize that this is a temporary situation, and we will look to bring inflation back to target promptly.
But in terms of the MP's efforts to anchor inflation expectations, haven't the politicians, when they make statements like that, haven't they altered the goalposts on the Bank and the Monetary Policy Committee? Well,
I would note that our remit was confirmed within the past several weeks. The remit confirmed it 2% inflation target. What's important is, and I appreciate the line of questioning, because what's important is that workers and businesses and people in general understand that this is a temporary phenomenon. Yes, it does mean more purchasing power at the moment. Yes, it will provide some support for the economy as a consequence of that. But at the same time, that the MPC will conduct policy in order to bring inflation back to target, and it promptly, as I say, within 2 years, and that should inform people, particularly as they're forming judgments about appropriate wages in this juncture in the economy.
Did any of the members of the MPC raise this with you, what the Chancellor said in his autumn statement? Or do any other members have concerns when politicians don't reflect the target that's been set?
Well, I think the key point is that, as the Governor said, what everyone is welcoming is that real incomes are rising, and that is in part a consequence of much lower oil prices, but it's the increase in real incomes which is good news for everyone.
Any other views?
Well, I think what would be worrisome if there were signs that inflation expectations of household companies were building in an expectation of extremely low inflation well beneath the target level for many years into the future. But that really isn't the situation as far as I can see.
Governor, you're Canadian. If I can use an American analogy in terms of some insider baseball here, were any of the other members involved in writing the letter to the Chancellor after the inflation had fallen below 1%?
Yes, we We circulated, we went through several drafts of the letters. All members commented on the letter, and members knew the contents of the letter prior to its being signed and sent to the Chancellor.
Okay.
And may I say, it's paramount, Mr. Carney, it's paramount that the letter is consistent with the inflation report, with the MPC's forecast and its expectations of and its judgments around the appropriate time horizon to bring inflation back to target.
Okay. Can I just ask a quick question of follow-up, Dr. Carney, from last time? We talked slightly about, if you recall, about our exposure to the situation in Ukraine, and you were saying the bank's exposure wasn't that great. And I'm still quite worried in terms of, I met a major manufacturer in my constituency yesterday who've got tens of millions tied up there, and they feel quite exposed to the situation. Do you think it's deteriorated or got better in the time since you were last in front of us?
It is, well, obviously, it's fast moving. The circumstances on the ground, the geopolitics overshadow the economics at this stage. There is, there's tentative positive developments in terms of the ceasefire that has been agreed. There's also the scale of the IMF program is a positive development since we last met. But the economic situation in Ukraine and the economic situation in Russia, to which a number of there will be individual companies who have exposure, and we also have indirect exposure through other economies to Russia. The Russian economy is in recession and will be in a relatively deep recession this year, in part as a consequence of the hostilities.
Thank you. Stuart Hosey.
Professor Miles, in your speech recently, what can monetary policy do? You argued that in the UK, the government has accepted that any fiscal consequences of the setting of monetary policy to hit the inflation target are something it will need to adjust to. Isn't it a legitimate concern that when the time comes, and it may be sometime in the future, to unwind QE, that acceptance you talk about will be lost?
I don't think so. I mean, I think whatever the sort of fiscal implications of the QE operation are, which to date have been net positive, in the sense that we've earned more income on the assets than the cost of the funding, which is linked to bank rate. But whatever the long-run implications are, they'll flow through to the fiscal balance and will feed into the overall fiscal strategy, whatever that is, of a future government.
So you've little or no concerns that if we took a decision, the government took a decision to unwind QE, that we would still learn the lessons and accept there would be fiscal consequences, whatever they may be?
Well, I think there will be fiscal consequences. It's a bit hard to judge at the moment whether they're net positive or negative over the long term. It'll depend, what the situation is at the end of the operation when you've unwound it all. I mean, it may well be that the bank, and this is another part of the speech actually, it may well be that the Bank of England's balance sheet will remain much larger well into the future. And so it's not obvious that the great majority of the gilts that have been bought by the Bank of England end up being sold, even when you got back to a neutral monetary policy.
I'll come back to that point slightly later, but you also said in the speech some people seem more keen than I think is wise to move away from the centrality of the inflation target. Which people were you thinking of?
Oh, I think there's quite a lot of commentators around the world. I mean, not just in the UK, but more widely. There's a lot of academics who say, the lesson of the last few years is that having an inflation target's too narrow. You need a broader set of targets for monetary policy. You need to take into account the financial stability issues, what's happening to income inequality. I mean, a whole range of things that some people want to add to the list of things that a monetary policy committee needs to try and address. And I think that's my own view is that that's not the most coherent way to go. That if you give a monetary policy committee several different targets, you may end up not hitting any of them. And I also take the view that actually hitting an inflation target by no means involves ignoring what's happening in the real economy and being very concerned about unemployment and slack. I don't think there's a conflict between trying to hit an inflation target and worrying about the efficient utilisation of resources. I think they're complementary, really.
I think that's helpful. So Governor, on that point, Professor Miles also argued in his speech that flexible inflation targeting is not inconsistent with attaching significant weight to short-term fluctuations in output and employment, which is just described. But, he said, having some target for growth or employment over the medium to longer term as part of the remit for the central bank is a different matter. I think there's little to be said in favour of that, which we've just had paraphrased. Do you agree with that?
I do agree with that. I think it's very well put. And if I can bring it to the current circumstance, we have a situation where part of our judgment about the path to return, how to respond to, I'll simplify it to the oil price shock, is a determination of whether we could lean against that to bring inflation back more promptly to target. The fact is there's lags in the effectiveness of monetary policy. Peak impact somewhere between 18 to 24 months is our experience. That oil price effect in terms of CPI, maybe not in the underlying economy, but in terms of CPI, will have washed through over the course of a year. So we look at those the short-term variability and take that into account.
You've described this earlier in the hearing, the way you would look through certain short-term hurdles, and I understand that. And obviously you agree with Professor Miles, and that's good to have that consistency. But you do have the unemployment knockout, which allows you to reconsider the forward guidance. Are these things absolutely compatible?
Well, they are compatible. To go back to forward guidance, the first phase of forward guidance. So, and to be clear, that no longer operates because we went through the knockout. The point there was putting in guidance as the recovery was just beginning to gather steam, and to provide perspective on a necessary condition for the consideration of potential tightening of monetary policy, in other words, raising of interest rates. So we used that as an indicator, as a knockout, to say that we were unlikely to even begin to think about tightening monetary policy until unemployment had reached that level. It was a means to an end.
That's fine.
Provide guidance.
Just the other point Professor Miles made about perhaps holding more of the gilts than had previously been the case. Again, the speech, and we'll just use the words from that, it was very likely that the Bank of England balance sheet may stay very much larger than it was, but not because of a failure to unwind QE, but because banks would want to hold short-term reserves. Now, you've alluded to this before in answers to myself and to John Thurzo.
Yes.
That's a much more concise way of putting it. So is this now where the bank is moving to? Basically a tacit acceptance or a public statement that even if QE is all unwound, the level of gilts held will be substantially higher for the reasons given.
Well, let me build up the answer. The first point is that historically the bank had not backed all of banknotes in issuance with gilt holdings. Okay, so currency in circulation haven't been backed. The bank had taken a decision prior to the crisis that we would move gradually to a position where we would back all the currency in issuance with gilts. It's a sensible thing to do. Given our holdings of gilt, it's sensible, and Dr. Broadbent oversees it, that we would move to that position. That in and of itself will leave a higher standing state balance sheet, a higher holding of gilts on the Bank of England balance sheet. First point. Second point, which Professor Miles, to which he was referring in the speech, is a question of liquidity management at private banks. They have new regulatory requirements, but also, I would add, perhaps a new appreciation of their responsibilities to manage their own liquidity, not be wholly dependent on a central bank safety net. That will mean holding more liquid securities and potentially more bank reserves. The last, which again is consistent with a bigger size of resting equilibrium size of the Bank of England balance sheet, said different ways. But the precise question of how we manage reserves in the system has not yet been determined because we haven't begun yet to move interest rates off these very low levels.
And just one final question then on that issue of liquidity cover. I mean, from memory, I think the Basel rules insisted that moves to 100% over the 5-year time frame or something like that. Do you think the public are aware that the banking system is becoming safer, specifically because there will be effectively 100% liquidity cover?
Well, it's not clear that I think public awareness of the considerable improvements in the resiliency of the banking system have been overshadowed somewhat by continuing problems with conduct of those institutions. So there's a recognition that the system has moved back from its very fragile state in the wake of the crisis, but probably not a full appreciation of the extent to which the system has built resiliency both in terms of capital and liquidity. And that's entirely understandable given the headlines people are faced with every day.
No, that's helpful. Thank you, Chair.
Dr. Broadbent, do you think these conduct issues are reaching the point where they're inhibiting banks from supporting the economic recovery?
Well, they've certainly gone on, excuse me, for a depressingly long time. And I'd mainly echo what the Governor just said. I mean, I think the more important impediment to the supply of credit has been the weakness of their balance sheets. And that's why the improvements we've seen in the strength of those balance sheets over the last 5 years is extremely welcome. And without it, I doubt we'd have had the recovery we've enjoyed over the last couple of years, for example. But probably at the margin, yes, it is at the very least a distraction to the executive.
But it's marginal, not central.
I don't think it's prevented a recovery in the supply of lending over the last couple of years.
Less strong recovery than we would otherwise have. You're saying it's a marginal effect, whereas you're saying what's gone on with balance sheets has been much more important. I would imagine that's more important, which is not to underplay the importance of conduct issues. In their own right. They're just trying to get their
yes. No, I think the more important
impact in perspective.
Yes, indeed, more important.
Okay. Loksham.
Weale, just turning to the latest set of MPC minutes that have been published. With regard to the base rate, it notes, and I quote, "For two members, the immediate policy decision remained finely balanced. Given the outlook for inflation beyond the short term, there could well be a case for an increase in bank rate later in the year." Were you one of those members?
Well, that is my view that things are finely balanced.
Could I just ask you, why is that? Given what the Governor said about inflation and general expectations in the market, why do you think it's so finely balanced?
Well, my sense is that wage increase, or the labour market is getting fairly tight. Unemployment has continued to fall fairly rapidly. Average weekly earnings growth has picked up certainly faster than I was expecting. It's a volatile series. It may go down again, but the sort of pressures I had thought we might see in the labour market towards the end of this year perhaps are starting to show earlier. Now, of course, we have a target for CPI. We don't have a target for wage increases or a target for domestic costs, and the effects of rising wage costs on CPI are attenuated through things like the import content that's not affected by not directly affected by wage growth, but my concern is that the labour market is tightening, and that eventually that is likely to prove a limit on on our ability or the desirability of keeping interest rates as low as they are.
So, Dr. Broadbent, I saw you nodding when Dr. Weale was speaking. Does that mean that you were the other member of the MPC who shares a similar view?
No, it doesn't.
Okay. So what?
Well, I don't think was I nodding? I don't even know
where I was
nodding.
Given what Dr. Weale said. Can I just return to this point? The minutes also note that, and I quote, "All members viewed it as more likely than not that the bank rate would increase over the next 3 years." And for one member, the next change in the stance on monetary policy was roughly as likely to be a loosening as a tightening. Is the member who had that particular view present today?
Can I just say, look, we assign individual names to the most important things in the minutes, which is the vote.
Sure.
There is at any point in time typically a range of views about all sorts of things in the economy, and at times about policy itself.
Okay, but let's cut to the chase. Let me ask you then, Dr. Broadbent. Dr. Weale's been very clear in terms of what he thinks may happen in terms of the base rate. What is your view? I mean, do you have a 3-year view on this, a 2-year view, a 1-year view?
The clearest way of seeing what the collective view is to look at the forecast. And in the forecast, a moderate rise in interest rates is necessary to produce inflation rising back towards the target within the kind of horizon that we think is appropriate at the moment. And therefore, that is also my view, I would say, that roughly speaking, we need a moderate rise, and therefore that it's more likely than not that the next move is up.
Okay. But so Professor Miles, could you just comment on that? And when do you think this likely modest rise is going to come?
Well, I was very happy with the statement in the minutes, which was the collective judgment that over the next few years, the most likely outcome is that bank rate gradually moves back up off where it is at the moment, back toward a more normal level. Probably doesn't get back to the old normal, but moves back in that direction at least. My own view is that the outlook at the moment means that we shouldn't be in a great hurry to be normalising policy and moving up bank rate. The inflation outlook for the very near term is that it stays very low, but that looking beyond that, and as is reflected in our forecasts in the inflation report, if one were to leave bank rate unchanged in those projections in the inflation report, the central expectation then would be inflation would start moving above the target and would end up materially above it 2 or 3 years down the road. So that, I think that's a sensible judgment, and that says that at some point, probably not immediately, but at some point, bank rate does need to go up.
Right. Governor, could I turn to the housing market with you? Could you give us your sort of current views on this?
You're not interested in my view on that?
We're always very interested in your views on everything. If you'd like to give us those views, we'd be delighted. But perhaps
it's all right.
After you give us those views, you must give us your views on the housing market.
Look, I was nodding and shaking my head at the same time.
To say, Governor.
No, I don't. But I just found it amusing
Put that on the
wasn't asked. As Professor Miles said, and Dr. Broadbent said, if you look at the forecast, inflation gets back to the 2% horizon within 2 years, which is the stated objective of the MPC, given the shocks that are hitting the economy in this case. And it goes a little bit above 2% farther out in the horizon. And that is a forecast that uses the then market curve, which is consistent, not with any cut in interest rates, but with modest increases in interest rates. And that is, in my judgment, what is likely to be the case at the current juncture. Okay.
So just turning briefly to the housing market, I mean, what do you think is going to happen over the next 12 months in terms of house prices?
We have, as the MPC, a view that house price growth nationwide will decelerate relative to the levels in the previous year. That broadly, the growth will be consistent with income growth. So in the range, I should be careful here, given that real incomes have moved more sharply, but in the range of 5-6% annualized basis. Now there'll be substantial regional variation in that.
Right. Okay, so
but I wouldn't bet my house on that.
Okay. Well, final question on this, on the Help to Buy scheme.
Yes.
I think it was reported in October that you and the FPC have taken the view that the Help to Buy scheme doesn't pose a material risk to financial stability and is not contributing materially to house price growth. Do you continue to share that view?
Well, the FPC does continue to have that view. And because the FPC has made it clear that if the view were to develop that the Help to Buy scheme posed risk to financial stability, it would make those views public and it would alert the government to that fact, and it has not.
Okay, and it would alert the government to that, not at the sort of review point of every September.
No, it's not. The government's expressed a desire for a review every September, and we will acknowledge that. But as is the case with, if there's any policy or set of circumstances that are contributing to risk to financial stability, we have an obligation to, if they're policies of the Bank of England, to adjust those policies. If they're policies of the FCA, to alert the FCA, make judgments, and in this case, if they're a policy of the government, to alert the government, and we would do so, yes.
Thank you.
Just for clarity's sake, who was this member who viewed the stance of monetary policy to be roughly as likely to lead to a loosening as a tightening?
Well, I'm not sure. I think it's up to the individual to reveal that in due course and the rationale behind it is but just to put this in context. So we have.
Perhaps
if I may,
you could
Chairman,
provide a bit of context by telling us whether that person asked for his view to be added to the minutes.
Well, of course, everything that's in the
Whether
minutes.
he specifically asked for that view to be added to the minutes.
This is dancing on the head of a pin, if I may,
Okay.
Chairman. It's a 9. This is an important point because I don't think we should. There should be any confusion coming out of this worthwhile set of issues. It's a 9-0 vote to keep policy the same. First point. There is nuance provided around that vote. Some members think it's finely balanced. One member has that view. The rest of the members do not hold those nuances. Next point. Every member of the committee's judgment is that rates are more likely than not to be higher at the end of the forecast period than they are today. Next point, the best collective judgment of the committee, consistent with the forecast, consistent with the letter, the chairman, or to the chancellor, is that modest increases in interest rates will be necessary to achieve the inflation target.
Okay, that's helpful.
Can I just add something?
It wasn't you, though.
There was some speculation in the press that it was me. I just wanted to say that it was not me. I did not
Okay,
take
so it's four down and 5 to go, and we'll move on to Andy Love.
Maybe next week we should have 4 other members of the Monetary Policy Committee.
And I'm not sure. Here's my slight concern about this discussion. It's worthwhile, and obviously, is that I wouldn't want a member of the general public to misinterpret, or market participants or others to misinterpret the discussion. The best collective judgment of the committee is the next move is likely to be up, that modest increases in interest rates are consistent with achieving the inflation target, that we'll do what's necessary in order to achieve that inflation target. I appreciate the nuance and the salami slicing, but in the end, what matters is the weight of opinion on the committee and the decisions of the weight.
Governor, can I come back to the risks of deflation? The bank's forecast for inflation later this year is it will enter negative territory. You've explained that this morning in answer to questions from the chairman as being primarily related to reduction in energy and food prices. But how likely is it that price or wage setting decisions will be affected by a period of negative negative inflation?
Well, first thing is that we expect very low inflation, possibly very low inflation for most of this year, possibly negative inflation. That determination of the latter will be largely, not exclusively, but largely determined by the evolution of oil prices, petrol prices, other energy prices. The prospect of that influencing wage setting is in part, in our view, determined by inflation expectations and in part determined by that and the extent to which individuals, companies expect inflation to return to target in a timely fashion. It's also obviously a product of the relative tightness of the labor market and through the fullness of time a function of productivity growth in the labor market.
How extended a period of negative inflation do you think it's necessary for that to feed negative inflation to feed through to prices and wages?
I think one of the things we do identify in the report, and if you're a keen reader of the fan chart in the CPI, as I know you are, Mr. Love, we have a slight downside skew in the near term of the fan chart to inflation, and that's because of the possibility of greater persistence of low inflation. So the possibility that that low inflation breeds further low inflation for a period of time. So there is some possibility of that. That's not our central expectation, but there is some possibility of that, and we try to incorporate that in our risks around the inflation forecast. We do view, when you get to the 2-3 year horizon, the risks around the inflation forecast to be evenly balanced, not least by some of the points that my colleague Dr. Weale has made.
Were you surprised that the survey carried out by the bank's agents showed that inflation expectations was the most cited factor likely to bear down on labour cost growth in 2015? The very scenario that you're saying might not happen.
I wouldn't say we were surprised by that. It's an important piece of information. I would add, though, that the wage setting survey by those same agents of those same companies is consistent with wage growth of about 2.5%. So it's not what the information from the survey, and that's corroborated by other surveys, some of which suggest even stronger wage growth, certainly for new hires, than that. So in the end, even though companies were taking into account the prospect of lower inflation and lower other costs associated with that, their expectation on average was what I would term solid wage growth. But that's, again, Mr. Love, to put this in context, historic average wage growth would be around 4%. Something consistent with an economy operating at equilibrium would be around 4% annualized wage growth.
Japan has had experience of deflation for some considerable time. Is there any lessons to be learned from the Japanese example?
There's numerous lessons to be learned, and many of them have been applied. The first is the need for vigilance against deflation and the possibility that deflationary expectations would set in. The second is the importance of, and I would say in terms of the vigilance and the responsiveness, monetary policy did respond very rapidly and forcibly here. Post-crisis, when there were concerns about prospect of very low inflation. We have kept an accommodative stance of monetary policy. In fact, we've foregone the tightening of monetary policy in part because of these risks. Another lesson from Japan is the paramount importance of fixing the banking system early, so that the natural capital reallocation process functions, so that companies that should die, and those that can be born, can access that credit. It took a bit of time here, but by 2013, the core of the banking system was substantially recapitalized, and I think one of the core lessons of the stress test that the bank conducted last fall was that the core of the system is resilient and resilient to another downturn, will retain an ability to lend to the real economy in another downturn. That's the judgment of the FPC of the Bank of England. So those are two core lessons that have been applied. We are vigilant towards risks of persistently low inflation. We care just as much about inflation below target as above. That's why we're watching inflation expectations closely. That's why we have the policy stance that we do have. Even though it's consistent with modest rate increases, they are quite modest and they're quite gradual. And that's in a context of an economy where the labor market is tightening, the economy is continuing to grow above trend, and can be expected to do so over the forecast horizon, at least in our view.
I assume that you have seen the Daily Telegraph's front page of Friday the 13th of February, where you quoted the title of the article is "Enjoy Low Prices While You Can," but you're quoted as saying families should take advantage of cheap petrol and food as take-home pay rises. Do you have a strategy to boost consumer expenditure? Is this something that the MPC...
No, I think one, with respect to the changes in food and energy prices, one should recognize where they came from. These are exogenous, by and large, they're exogenous effects. They came from outside the UK. Now, that's less true for food because part of that is a product of intense competition in retailing and much of the food consumed is domestically grown. But certainly in the case of energy prices, these are dramatic falls in the price of particularly crude oil. It's a one-time effect. It helps boost real incomes. It's not a strategy. It's something that's happened. And the question is, how do we respond? As we've been discussing, rightly so, our view is that we look through that effect. It has the consequence of boosting real take-home pay, particularly if wage settlements are anything like the expectations of the companies that our agents have been surveying, the companies we've been meeting across the country as we go around, the companies that have been reporting into other surveys such as the REC survey. So there will be a boost which helps support relatively strong growth in consumer expenditure without a material drawdown in household savings over the near term.
But while you're
this is I'm sorry, Mr. Love. This is a temporary phenomena. So enjoy it while you can, because it's not going to last. Petrol prices aren't going to continue to fall. Food prices aren't going to continue to fall.
I think the point that the Daily Telegraph was trying to make was that in this period when prices will be falling, consumers may be incentivised to withhold expenditure. And they were suggesting that the MPC was alert to that process, and you were, as the spokesman, suggesting that people should keep spending.
I understand your point now. I think I'll associate myself with Dr. Weale's comments, and actually Professor Miles made them in a different context, which is that we don't see a lot of evidence of deferred consumption in this country, past or at present. I think the greater risks from deflation, or persistently low inflation, the reasons we have a 2% inflation target relate to the functioning of the labor market and financial contracts, long-term mortgages that are taken out with certain assumptions of what the wage and price inflation would be. And if we go off target, then it won't be consistent with the economy functioning well. And the term we've used, or at least I've used, is that a little bit of inflation greases the wheels of the economy, and that is true. And that's why we do target some inflation.
Mark Carney.
Thank you. Can I also appreciate everything you've said about the fact that this very low inflation rate is a temporary measure, and this or temporary thing is going to probably pick up again. But in the event that you're wrong, not that I'm suggesting for a moment that such great minds would ever get this sort of thing wrong, despite what Robert Choate keeps saying about economists. But if you are wrong, and there has to be a further loosening of monetary policy, can I also take a range of views across the panel? Perhaps we'll start with Dr. Broadbent. Would you prefer a lowering of the base of the bank rate, or would you prefer more quantitative easing?
Well, we don't have to take that decision yet. As we set out in the letter, however, we have changed our view slightly of what is the effective lower bound in the UK for the official interest rate. Previously, the judgment was that any cut, should they be thought necessary, below 0.5%, might have perverse effects by damaging the margins, profits, balance sheets of certain financial intermediaries. Because those balance sheets are now stronger, we no longer think that's the case.
Quantitative easing came in the first place, as opposed to
yes,
below.
Yes, partly. I mean, let's be clear that if one was to try and translate the one into the other, the effect of quantitative easing was much bigger than the sort of margins on bank rate we're talking about. But I don't think we've reached any judgment as to whether we'd use one in preference to the other, because, of course, as we've spent the last several minutes discussing, everyone on the committee thinks interest rates are likely to end up higher by the end of the forecast period,
But on the hypothetical thing, I mean, if you were pressed,
I understand, but that is what I'm trying to tell you. That will be a judgment of the committee as to which we use. I don't think we have in advance any prejudgment as to which of those instruments.
So, I mean, is that the same for everybody? I mean, rather than going through it, does anybody have any strong feelings one way or the other?
No, I think it's a purely hypothetical case, and should the need arise, the right thing to do will be to look at the circumstances at the time and see what is the most sensible decision.
Yeah, I agree with my colleagues. Once one gets into hypotheticals, you can have many hypotheticals, and certainly where we started this hearing on euro area issues and contagion and broader crisis. Channels might merit a certain response that a more conventional slowdown and persistent disinflation might otherwise. Let me underscore, though, that it is quite handy that we have the ability to use conventional monetary policy if we were to need to, and that helps inform the stance of policy at present.
I mean, one issue of this, I mean, were it to come to this hypothetical situation of conventional monetary policy or QE, obviously the Treasury has a view in this because the government is underwriting the QE, as I understand it. Have you had any discussions with the Treasury about this and what their appetite would be to any further quantitative easing?
The short answer is no, and the decision of on if we ever were to come to a case where we were the view of the MPC was that additional stimulus would be required, and I would remind you that we vote on this each meeting, and it is entirely possible that a vote could go in any direction. Those are the decisions of the MPC. The asset purchase facility is in place, the indemnity is in place, and those decisions would be the decisions of the MPC. I think this is the point, though, in the discussion where, and you've been very careful to say this is a hypothetical, where I'm duty-bound to, again, insert into the transcript that this is a hypothetical. It's not an active hypothetical discussion at the committee.
No, I
just to be
that.
clear.
But it certainly came up at the MPC press conference. Robert Preston was pressing you quite hard on this particular area, and in fact, this comes to the next bit, which is the potential of negative actual interest rates, as opposed to negative real interest rates. This is something which does come about under kind of extreme conditions. We've certainly started seeing this in parts of the Eurozone. Do you think, again, completely hypothetically, that it's possible that we could see negative actual interest rates in the UK? Is that something which is conceivable, or is it simply not going to happen?
Well, I think the judgment of the committee is that, as expressed in both the letter, in the letter specifically, is that because the banking system, the resilience of the banking and building societies has increased, we're in a position where we could, if necessary, cut bank rate towards zero. That's towards a level that still is above zero. We haven't specified a specific level. We haven't had to. We're not having the active discussion about it because the focus of policy is towards timing and degree of tightening when appropriate. The countries, both in both the ECB and other countries in Europe, but not as part of the euro area, Switzerland, Denmark, and Sweden as example, with the exception of the last, in all of those cases, the negative interest rates have been applied not to their core policy instrument, but to the rate paid by the central bank on effectively deposits at the central bank that are excess reserves of the banking system at the central bank. Now, it depends on the relative size of those excess reserves relative to reserves, the extent to which those negative interest rates start to translate out into actual deposit rates, rates that individual savers would see. And that hasn't always been the case, or that hasn't yet been the case in some of these jurisdictions, but it will be over time.
But it has happened in places like Hong Kong, if I remember rightly.
To be. So there are other systems, systems that have excess reserves that have used this so-called stepped floor approach, playing a negative interest rate on some of the reserves. We don't have that system, first point. We also have only taken a judgment about the ability to move bank rate towards zero if necessary and we of course disclose that as part of the process of writing the letter to the Chancellor to explain why inflation is below target, what our strategy is to bring it back. And again, I'm repeating myself, but I think it's necessary to do so. Our strategy to bring it back, as best as we can tell at this point of time, given the shocks that have hit the economy, is consistent with modest increases in interest rates over the forecast horizon. In other words, the bank rate is more likely than not to be higher than it is at present at the end of the forecast.
Okay, fair enough. Thank you very much.
John Thursday.
Can I come to you first, Professor Miles? And I want to talk about productivity. How concerned are you about persistent below-trend growth in productivity, and what analysis, if any of you, made of that?
I think it is concerning. I'd been more optimistic, certainly a couple of years ago, even a year ago, I'd been more optimistic that we would now be seeing more normal rates of productivity growth. We've seen some productivity growth over the last couple of quarters from the latest data, but it's still below what we used to think of as normal rates of productivity growth. I thought that as unemployment came down and we got back to more normal rates of growth, we'd see more normal productivity. So I've become a bit more pessimistic on all that, and on the back of that, slightly more pessimistic about how much slack there is in the UK economy. Having said all that, I do think that there's a case to be made for the most likely outcome being that you gradually do get back to something that looks a bit more normal, 1.5% to 2% increases in labour productivity year on year. So as a long-run place that the economy may get back to, I think that remains pretty plausible. It's just the process has taken far longer than I thought.
I mean, when Professor Nicol came before us, the OBR in December, he took a sort of similar view that although it's been going on for 6 years, it's not yet the time to say that there's been a change to the long-run rate. At what point do you suppose, 6 years having gone by, one actually says the long-run rate has changed, and what implication might that have for our thinking?
Well, I suppose one answer to that would be when you had got back to a situation where all the slack had been used up, so that unemployment had fallen to an estimate of its sustainable rate, when people said that they were working on average the right number of hours, as opposed to the situation at the moment where more people than not say they'd like to work more hours. So if you took that as one's yardstick of a normal equilibrium position for the economy, which to my mind is still a few years off, if at that point and beyond there was still no sign of productivity growth beyond the low numbers we've seen recently, I think I would start reducing my estimate about the long-run sustainable rate of productivity growth. But it's still a few years off, I think, at that point.
But really the key to all of this is an understanding of what's really happening in the labour market.
Yes, where our understanding remains very, very imperfect.
Right.
Yeah.
And there is some disagreement on the committee, is there, about the labour market and how big a gap there is?
Yeah, I mean, I think there's a range of views. I wouldn't say it was enormous at the moment, probably less than it has been in the past. I'm probably toward one end of the spectrum in thinking there's a bit more slack or spare capacity than the middle of the pack, but actually those differences are shrinking.
Okay. Perhaps then I can come to Dr. Weale. In your report to us, commenting on your voting record, you said that underlying this voting is a view that there is less spare capacity in the labour market than the committee's collective judgment has suggested. Why do you think that is the case? And where I'm going with this is what impact do you think it has on our reflections on productivity?
Well, there are a number of factors. One is that the people who move from unemployment or indeed from non-employment into work are typically paid appreciably less than the average wage. Now, I don't want to get into concepts of what fair wages are and so on, but also they seem typically to be less well qualified and have lower levels of educational attainment, and that's likely to mean that you get less than average output from them. That's no, not overall a large effect, but it is a material effect. No, another issue arises from the way in which you interpret people wanting to say they work more hours than they actually do. There are two measures of this. The one which attracted more attention was some work that David Blanchflower did, looking at the number of hours people said they wanted to work and looking at how that had changed. Well, I looked through those numbers fairly carefully and found that if you take people, in 1 year or in 1 month they say they want to work, say, 10 or 12 hours longer. A year later, the people who said they wanted to work longer are no longer saying that, or many of them are no longer saying that, but actually they're only working 4 or 5 hours longer. So there's a question how we should interpret those numbers. Now, the other measure of an hour's gap is given by people who are working part-time and say they want to work full-time. I suspect that the same phenomenon may be present there, and I also suspect that one of the factors behind working part-time when you would like to work full-time, or saying you would like to work full-time when you actually only work part-time, maybe having a partner who is out of work. And so, with a general sense of economic recovery, my suspicion is that component of the gap is likely to decline, to some extent of its own volition. But I should also say, or perhaps stress that the committee collectively, as the Governor mentioned, wants to do more work on the supply side, and we will all have studied it in more detail in time for the May forecast round.
But it remains the big conundrum, does it not, for all economists, OBR, yourselves, everybody, that nobody really quite understands why productivity has been below trend for so long, and the thinking that you are doing around the labour market is potentially a partial explanation of that, is it not?
Well, I'm not sure that it's an important explanation of low growth in output per hour worked. I mean, what I have noticed is that it is something of an international phenomenon. It's true that by the international standards, Britain is nevertheless a relatively poor performer. We have had some specific factors that Ian McCafferty mentioned last summer, like declining oil output. We may be more sensitive to movements in the productivity in the financial sector, but in aggregate that's not terribly important. I suppose one reason why I share the view that productivity growth is eventually likely to pick up to more normal levels is that for quite a long time, certainly since the Second World War, Britain has been tending to catch up with the high productivity countries, typically France and the United States, and even if world knowledge is advancing less rapidly, we do still have substantial scope for catch up there.
Okay, thank you. Dr. Broadbent, just any comment on those two answers on this question of productivity?
No, except to say, supporting what Martin has just said, that I think it's an issue that goes beyond the labour market. My own view is that weak productivity is not, it may affect the rate at which unemployment falls, but it's not solely, the explanation is not simply to be found in things that have changed in the labour market. There's something deeper going on. And I'd also point out that my own instinct is that the fact of the financial crisis, through some mechanism, may have had some bearing on this, because we've seen weak productivity growth after other financial crises as well. But you're right to say that we don't have a very deep understanding or...
Thank you. Governor, can I come to you and ask a different question, but related to the same subject, which is around the outlook for investment? And the inflation report notes that In the central projection, annual investment growth remains robust, reflecting support from low interest rates and past easing in credit conditions, the gradual recovery in global demand and domestic demand conditions. Yet within that, investment by extraction companies, which accounts for 7% of business investment, falls by more than 40% over the forecast period. Can the rest of the economy make up that gap? And how worried should we be about the non-extraction side of investment seemingly below that which we would like?
In terms of the extraction sector, as you would know, in Scotland is a fairly substantial adjustment that's underway. It's underway. We've adjusted our forecast because of that, and as you rightly note, 40% adjustment is significant. Partly as a consequence, the path of investment is somewhat lower than it was in our November forecast, but it is still robust investment growth as a whole, and that does reflect the factors that have been listed. There are a number of risks to that forecast, not least the external environment. There are declining risks from the domestic financial system, financial environment. So that drag has been reduced, but certainly anything that would impact confidence domestically or externally can impact it. We're not yet picking up in our surveys and our discussions anything material in that last regard.
Okay, thank you.
Steve Baker.
Good morning. Before turning to Eurozone quantitative easing, could I just return to the least controversial part of Mr. Norman's questions, which was Eurozone fiscal union? Who would have thought it? Professor Marks, you made a magnificent speech on what monetary policy can and can't do. Under the heading Fiscal and Monetary Policy, Symbiosis and Consistency, you quoted Cochrane. You said, we can read the inflation target, he said, we can read the inflation target equally as a commitment by the Treasury to fund debt at the targeted level of inflation, as it is a commitment by the central bank to target that level of inflation via interest rate policy. Could you just be clear that you're saying that there is a tight symbiotic relationship between monetary policy and fiscal policy?
Yeah, I think in the long run you can't have a situation where the fiscal authority needs, in order to be sustainable and keep rolling over the debt and pay the interest, needs an interest rate, say, at a very low level, and that was inconsistent with the central bank's view of the interest rate you need to hit an inflation target. So if there's a tension between those things, something's got to give in the longer run. I think that's the sense in which they have to be consistent.
And Dr. Broadbent, is this a common view amongst economists in your field of work?
Yeah, I mean, the circumstances David's describing, I would say, don't necessarily apply at all times. There is some constraint, ultimately, but it doesn't mean that from day to day we, have to coordinate with the fiscal authority at all, because I think we're a long way from that constraint. I mean, one way of putting it is that certainly in history, very rapid rates of inflation, hyperinflations, have been fiscal events, ultimately. But they've been fiscal events because fiscal authority has lost control of borrowing and because it dominates the monetary authority, and that's not the position, we're not remotely the position we're in anywhere in the developed world today, certainly not here.
So Dr. Weale, are we all nursing up to the intellectual leadership which the Governor has expressed by calling for a full or a more complete Eurozone fiscal union?
Well, I suppose I have asked myself, can I imagine other ways in which the euro area could function, and an alternative approach. It wouldn't give the same sense of a single entity that the Governor's proposal would be if each nation state managed to regenerate for itself a substitute for the interest rate tool that it's lost. This was one of the issues that was discussed in the work that was done on euro membership in, I think, 2003. how would you limit consumer debt growth and credit growth if you'd lost control of the interest rate? Now, certainly no one has tried that. There are very good reasons for not rushing into it, and I can certainly see that if the euro area wants to turn itself into something which is, much more like a federation, then it will need to go down the path that the Governor described.
So, Governor, would you recommend to the nations of Europe that they adopt a more federal structure, a more integrated and federal structure?
Well, I don't think it's necessarily a question of a formal federal structure. What I noted in that speech and consistent with some of the observations of other European authorities has been that there could be a twinning of labor market reforms, which are necessary, and unemployment insurance flows across jurisdictions. The advantage of that is clearly these are flows from individuals and companies to individuals as opposed to governments to governments and then dispensed by governments. So it reduces the political element to that and potentially the leakage in that. So it doesn't necessarily have to be federal, but in my view, there is a need to recreate that. There's dangers to try to recreate domestic monetary policy within a currency union, obviously. I'll leave it at that and let you continue.
We could talk about this for a long time, I'm sure. I mean, how has Eurozone QE changed all of your outlooks for the world economy and particularly for our economy?
Well, I think it's a very welcome development, frankly.
So as long as we just keep on creating new money and giving it to wealthy holders of assets until the cost of living picks up for ordinary people, everything will be well in due
I'm not
course.
sure, well, I wouldn't describe the transmission of QE quite in those terms, but what is clear is that the Eurozone the Eurozone economy is one which was short of potential. Clearly there's significant slack, where underlying inflation, not just headline inflation, but underlying inflation, even stripping out these more volatile components, was well below the level consistent with the ECB's remit, and that therefore there was a case for easing monetary policy. And two things in particular were welcome about the ECB's announcements. One, the very fact that it was now recognised that this was a legitimate tool of monetary policy, and two, the fact that it was made conditional on the things that the ECB really cares about, namely inflation. And I think both those were welcome, and at the margin they added to our central forecast of growth in the Europe and to the extent it affects our own economy growth here as well.
I realise I deliberately caricature the transmission mechanism, but isn't this in the end a reasonably close caricature? The bank has explained that asset prices are lifted, both in bonds and equities, about equally by quantitative easing.
Yeah.
We know that there's a distributive effect. That's been explained again by the Bank of England. We know that different income levels experience inflation differently. We know that we're looking at a temporary fall in food and energy prices, which would be very welcome, particularly to those on lower pay. And I think we also know that the bank has said very clearly that you'll take whatever action is necessary to return to the inflation target. So it feels to me like a very welcome fall in the cost of living actually will be fought, if it goes on for too long, by the bank engaging in perhaps quantitative easing, which will again help the wealthy. And it feels to me like although it may seem I'm caricaturing what you're doing, but I'm only actually relying on your own papers. Dr. Wilson.
Sorry, could I make one point? I mean, it's important to distinguish changes in a monetary phenomenon, the inflation rate, from the sort of factors that have temporarily pulled or have pulled the price level down recently. The price of oil sometimes falls, it sometimes goes up. When the price of oil falls, that is good news for people who buy petrol, people who buy domestic fuel, and so on. And it is that phenomenon which is largely behind the current fall in the rate of inflation. Now, one could have imagined a situation where the constellation, perhaps a bit hard to imagine, but one could have imagined a situation where some other prices and wages had picked up just as the price of petrol had fallen. That would have delivered the same impact on the living standards of working people, but inflation would have been closer to target.
I care very much what the Governor thinks about this issue, but I do just want to reply to you by saying I remember Friedman's stricture that inflation is everywhere, always and everywhere, a monetary phenomenon. And in your letter, in the bank's letter about inflation rates, it compares a period, I'll find it again, in Table 1, the 1997 to 2007 average inflation compared to December 2014. So I just printed the quantity, out a chart of the quantity of M4 outstanding. You can probably see from there since I've highlighted it. During the period when, of historic inflation, 97 to 2007, the quantity of M4 outstanding doubled in an accelerating rush, whereas in the period since the crisis, M4 outstanding has been broadly stagnant.
And inflation was higher.
Yeah, and inflation was
crisis than before. So
so in fact, that's exactly right. So, if Professor Friedman were here today, you'd have a case to answer, because that actually shows the exact contrary of your point. Now, what it does show is the importance of looking, and this is a point you've made in the past, the importance of looking at broader monetary aggregates, from not least from a financial stability perspective, because what a closer scrutiny of M4, its components, what was happening in the financial sector at the time, might have indicated is some of the problems that were to manifest subsequently. If I can go back to your basic point, and I marvel at your jump from the ECB to and the situation in Europe, which is quite different to the situation in the United Kingdom and the Bank of England's policy. So I just want to correct a few things, if I may. The first is, why do we have a 2% inflation target? Why is it important for us to get inflation back to that 2% target? The very first point on that is, it's not even for us to ask, because it is a mandate of Parliament. We have a remit. Our job, we have operational independence, how to get inflation back to target, but we don't have goal independence. But the reason Parliament in its wisdom has set this remit is that a little bit of inflation does help the economy function. And you think about less well-off constituents that you would have, fellow citizens across the country. They have debts, disproportionate amount of debts taken out at certain expectations of inflation rates and wage rates. Those will be harder to service in the event of persistently low inflation or deflation, much harder to service in that case. So their real standards of living will very rapidly decrease. And also we want the labor market to function well. And a little bit of there is downward wage rigidity, even though this is a very flexible labor market, and a little bit of inflation helps wages adjust, helps people move to jobs, and that is amongst many other reasons. That's why we've chosen that target. But to get back to the sort of logic train you had there, it is not our strategy, it is not our intent, as I think we've made clear today, as we sit here today as representing the MPC, that we would engage in additional quantitative easing. That's not our expectation. Our expectation is that to achieve the inflation target in a timely fashion would be consistent with modest increases in interest rates over the forecast horizon.
Of course, I don't mean for a moment that you're operating policy to harm the poor. I know that you're not. But what I'm trying to do is challenge the intellectual consensus, because I think there's something wrong with it. I mean, Professor Miles, in that marvellous speech, you indicated that there's a disconnect between the way that theoreticians see the operation of monetary policy and the way that practitioners like yourselves see the operation of monetary policy, and you explained that in any other field that would be seen as really quite worrying. Are you worried about that theoretical disconnect from the practical world and what it means for the lives of ordinary people?
Yes, I am in a way. It's partly a reflection of how economics is taught in schools, particularly at universities, and the models that are used are a bit stylized and don't reflect the structure of a modern economy. In fact, one of the senses in which I think it is unhelpful in some ways, the way economics has gone, coming back to the issue of quantitative easing, well, I think I'm in a slightly different place from you. There's a lot of clever theoretical models that say quantitative easing can't work and it'll be a waste of time or possibly harmful. And I think they don't quite reflect the reality of the situation for the periods when we on the Monetary Policy Committee were actively buying assets. So 2009 was the year in which we bought more assets than any other year, 200 billion. And that was a period in which the financial markets were largely dysfunctional, particularly the corporate bond market. And I think one of the impacts of our asset purchases then was to bring down corporate bond yields, which made life much easier for companies that could issue in that market. And I think that did have an impact on their ability to get through that terrible year 2009. And I do think without that, unemployment would have been significantly higher, would have risen by even more. And that actually wouldn't have helped people on low incomes. And so I do question the argument that QE, you're buying assets, you're driving up asset prices, and it helps the rich. I come from a different position on that one.
I'm just quoting bank papers. I know I absolutely must stop, Governor, but if I may, I'd like to ask you one tiny question, just for the record. Can you
this really is the last question.
For the record, could you just confirm that the Bank of England does not participate in the CME Group's central bank incentive programme?
If I may, Chair, two things. I can confirm we do not. We do not participate in that. Secondly,
this second
is very short. We'll take it.
Yes,
otherwise we'll have to move on.
It's linking theory and practice and research, and I want to make a plug for our new research strategy, our research conference, which is tomorrow, led by Dr. Broadbent, Mr. Hal. But it gets to this point, this very important point about bringing back theory and practice. And Mr. Baker will be pleased to know that one of the legs of our research strategy is around disruptive technologies, currencies, and implications for the monetary system.
Roshanar Ali.
Thank you, Mr. Chairman. I won't subject you to any graphs, Governor.
Okay,
I just wanted to focus on the wage pressures. The Bank of England's inflation report forecasts a 3.5% growth in wages over the next year and potentially higher subsequently. What are the factors driving this optimistic figure?
Well, as Dr. Weale and others have indicated, and it's detailed in the report, there has been a tightness in the labour market, in all measures of slack in the labour market, whether it's unemployment, the participation gap, and the average hours gap, so-called involuntary part-time or involuntary involuntary part-time. All of those factors have tightened. That is supporting modest growth in wages. This is a return to modest growth in wages, and we think there'll be an acceleration as the labour market continues to tighten.
And how much are bonuses accounting for that prediction?
In the economy as a whole, we don't make a distinction between the two. I can tell you that the growth of the most recent figures are on the order of 2.1% economy-wide, all total pay, and about 1.7 economy-wide for regular pay, thereabouts. So it's significant. The bonuses are not exclusively in the financial sector, as you would appreciate. And I might add as well, there has been some shifting of which is hard to parse in real time, but there should be some shifting in the proportion of financial sector compensation that's paid as bonus versus as regular pay because of regulation.
Can I just turn to the special report released last week by agents from the Bank of England, which showed no trends of the kind of wage growth that of around 3.5%, and how much account has been taken of theirs, and perhaps Dr. Weale could also respond to that and your reflections on the differences and how much notice the Bank of England is taking of that report.
Well, we certainly we commissioned it and certainly took note of it, discussed it in the run-up to policy. Well, it is one of many indicators of the prospect for wages. We supplement them with other surveys. We supplement with the underlying measures of slack in the economy and our expectation for the path of the economy, which in some cases may be more maybe stronger than the companies surveyed, not least because of an expectation that real incomes will grow more rapidly than they had in the past because of the added benefit of in the short term, of the fall in energy prices.
And what about you at the lower end of the market, the new entrants? Unemployment is beginning to go down. What are your reflections on the sort of lower end of the market?
Well, we have seen for less skilled employment, we have, and you're drawing out an important compositional effect as well. What we had seen over the past year, is now tailing off, is that more of the job growth had been in lower skilled jobs. That had helped. As a consequence, there has not been wage growth in those jobs. That has meant that in aggregate, the growth in average weekly earnings has been slower than it otherwise would have been. Now, it's a good thing because there's jobs, but that has had the compositional impact of lowering average weekly earnings. As the mix adjusts, there is that impact as well on wages.
Yes. Could I just say that it's quite helpful to think of wage growth as being a combination of wage settlement and wage drift. Now, the sense certainly I get from the businesses that I talk to is that the information we have from the agents is the best information we have on settlements, but the story on wage drift seems to have been changing quite a lot. People at the businesses I visit are talking about how they need to offer pay rises to retain people, they may need to offer pay rises to attract people, and the sense certainly I've been getting is of a rather different picture from the story I was hearing a year ago. So that's how I reconcile the forecast with what we're hearing from the agents.
So you're very confident it's going to go up, because in the last year, between 2013 to 14, it was around 1.4%. So it's quite a dramatic shift. Obviously, that it will be welcome, but there is some scepticism about the projections that are being made.
Well, forecasts are forecasts, and there is obviously, as we at the bank have been at pains to stress, a margin of uncertainty around all of them. We only show the uncertainty of the key components, but obviously around these projections there is a margin of uncertainty. What we are also seeing is that if you look at average weekly earnings growth, not over the last year, but say 3 months over the previous 3 months, that is erratic, but it does seem to have settled at a rather higher rate, sometimes a bit below, sometimes a bit above 4%. So that is certainly an encouraging sign about pay growth that I have taken into account, and indeed one of the factors that has made me think that perhaps pay growth is picking up a bit faster than I was expecting.
And just finally, if there are discussions about increasing the national minimum wage, the recommendation's been made by the Low Pay Commission. But do you have any reflections on that, on increases at the bottom end?
Well, I haven't done any particular work on the effects of changes in the minimum wage, but obviously, people everywhere welcome increases in their living standards.
Would you suggest it should go up?
Well, we have the Low Pay Commission, whose job it is to answer those questions, and they have delivered an answer. Our job is to produce forecasts in the light of the decisions that bodies like them make.
Okay, thank you very much.
So there's a very straight back, Dr. Weale, and I think you encountered the ball as it was coming towards you. David Ruffley.
Dr. Broadbent, we've already heard from Dr. Weale about his views as to why the amount of capacity in his view is less than perhaps the collective view of the MPC, and he helpfully describes in his written evidence to us on the 16th of February on his voting record the hours gap point, which he's already alluded to today, that the ONS figures, labour force figures, suggested to me, and I'm quoting, that a measure based on what people said they wanted was likely to to be misleading. How misleading do you think that is? You obviously don't think it's quite as misleading as Dr. Weale.
Yes. I mean,
I just wondered why that was.
Let me come at it from a slightly different angle, which is wage growth itself. As Martin explained, the very recent figures show slightly faster growth than over the past, but what struck us over much of 2014 and indeed 2013 was that wages grew less quickly than we were expecting, given our estimates at the time of slack in the labour market. And that evidence is relevant too, I think. So what Martin's describes are his views about the way we construct our estimates of spare capacity in the labour market from the bottom up, as it were. What is also true is you look at it from the other end, from what you might expect to be affected by that level of slack, wage growth, you might come to a slightly different conclusion and think, well, there seems to have been more of it for some reason than we were expecting. So I sort of put weight on both those, and the fact that wage growth was weaker than we were expecting certainly in the latter part of 2013 and the first half of 2014 makes me think that somewhere, whether or not we can identify it in precisely the numerical terms that Martin talks about, there has been spare capacity in the labour market, and that to a degree, we will allow that to continue to pull down on wage growth relative to the sort of normal figures that the Governor was talking about. So it's a balance of things. I don't think it's possible to come at a definitive answer from any one bit of information.
No, and that's helpful. In his written submission to us, Dr. Weale also says that I was also concerned that the committee was more willing to raise its estimates of full participation when actual participations rose than it was to reduce them when the participation figures fell. What's your view on that statement?
Well, what is true, broadly speaking, is that participation in the labour market is significantly higher than would have been the case had averages within age groups stayed constant. Or to put it another way, the process of ageing of the labour force might have been expected to push down on aggregate participation quite significantly over the last 2 or 3 years. That's not what's happened, and therefore there's been something else going on to offset that, and the judgment we have to make is how much of that is structural and how much is cyclical. And there was a range of views about what that split should be. We will revisit that judgment periodically. We're going to do so again ahead of the next and in the next inflation report. But I also refer to the answer I gave a moment ago, which is the fact is that for whatever reason, wage growth through much of 2013 and 2014 was lower than we expected, and that makes me think that even if we can't specifically see where it exists, there was spare capacity in the labour market.
When you say for whatever reason, what would your educated guess be?
Well, we ventured some suggestions which are, you might expect to see reflected in participation.
Which is the market leader of all these possible explanations?
Well, I think it's true the various forces which might have persuaded people to stay in the labour market longer than people of the same age did some years ago. For example, maybe they don't expect to have the same income. They think they're going to be forced to stay in the labour market simply to earn the extra income they need to maintain current levels of consumption. There have been various changes in benefits which may have encouraged them to stay in the labour market. So there might be several reasons why a person of a given age approaching retirement or even beyond conventional retirement age is now deciding to stay and work, whereas the equivalent person 10 years ago did not.
That's helpful. You in the 12th of February Q&A session you had accompanying this report, you talk about a lot of people who lost their jobs in the recession, who lost their jobs as a result of the recession, rather than looking for work and being counted as unemployed, instead sort of dropped out of the labour force. But they would be able to come back relatively easily. Could you sort of put some numbers on that? Is that a weighty factor, people just coming off the claimant count?
Well, that is precisely the what I meant when I talked about the judgment as to how much of the changes in participation are structural and how much is cyclical. It's always likely to be the case, to some degree, that there are people who lose their jobs in a recession and who don't formally count themselves then as unemployed, but who, with only a little encouragement, and in particular only a small increase in wages, would nonetheless seek to return to work again. And that's what one would call, as it were, cyclical non-participation.
Yeah.
Now, one route to that judgment is the kind of questions that are asked in the labour force survey to which Martin was referring. But as he says, it's probably not the case that one can take those answers completely at face value. So we have to have other judgments about how you make that split. And as I say, we'll be returning to this in May. But it's not straightforward in the sense that it's not, if I give you a precise answer, I don't think it...
But is it a very significant part of the spare capacity in the labour market?
Currently, yes, that's our view. But as I said at the beginning, my own view is that you have to have some explanation as to why wage growth was weaker. That, for me, is the bottom line. Mm-hmm. And it seems to me the natural explanation is that there was spare capacity in the labour market, even if allocating that slack is not entirely straightforward.
That's very helpful. Final question, Dr. Broadbent, on the question of the dip in the last 3 months on productivity. It's been broadly a story in the past few quarters of a revival in productivity growth. What's your assessment of productivity growth in the next 12 months, the short-term productivity?
Well,
levels?
We've learnt to be careful about these forecasts. My hope is certainly that I see continued growth. As David said, the experience has been disappointing, less so relative to other countries, but certainly pretty disappointing relative to pre-crisis trends. We've been marginally encouraged by the fact that productivity does appear at least to be growing somewhat. But I would describe our forecasts, even if I share the medium to long-term optimism expressed by David and Martin, which I do, our forecasts are relatively cautious, I'd say. We have a forecast in which growth exists and picks up gradually, but even by the end of the forecast period, it barely gets back to the sort of average rates that we saw prior to the crisis. So I don't think our forecast is unreasonable, and there might be various reasons to do with repairing the scars left by the financial crisis why you should expect marginally faster productivity growth than we've had to suffer over the last 5 years.
Thank you.
Governor, earlier in the session we had some exchanges, and you've had exchanges with other members about the identity of this one person who doesn't agree with the other 8 about the likely direction of tightening of policy that he or she thinks is likely to be a loosening as a tightening. And you gave a good explanation for why you think it would be important not in each case to identify the person. But in this case, don't you think it would be in the interests of, there would be some good explanatory value for the public if, in due course, that person were to set out in a speech why there is such a different view held by that person?
Yeah, I think it would be logical that, all of us as members of the committee have responsibility to explain our views.
Okay.
This is a nuanced view. And that individual can explain it in due course.
Maybe it's not as stark as it appeared in the minutes. But I'm not going to ask you to elaborate now. You've given me the response that I expected and hoped for, which is you see merit in having an explanation.
Yes, but I'll also repeat, I won't repeat, trust me, Chairman, my previous answer, but my previous answer...
We try and avoid repetition.
I will refer to it to put this in its proper context, which is that...
I'm sure that will happen.
I think we spent more time on it in this hearing than it possibly merits.
Okay. Well, we don't know, do we? That's why we've been asking the question.
Well, I know what I think.
Just to go back to the deflationary expectations exchanges that have taken place also between you and me and a number of members of the committee today. Is the biggest deflation risk the Eurozone?
The biggest potential shock, yes. I would agree with that, yes.
And therefore we have a huge vested interest as a country in seeing the Eurozone crisis resolved as speedily as possible, rather than this continuing, as I put it at the beginning, as variable weather.
We have a huge interest in in a more sustainable evolution in the Eurozone.
A polite way of putting it. Yes.
And of course, the members of the member states have an even greater interest in resolving.
All right. Okay. Thank you very much for coming to see us. What is now almost this afternoon, still this morning, and it's been extremely interesting, and we're very grateful to you. And we'll see you next week on a much more detailed subject, which we'll discuss for more than the 2 or 3 minutes that were allocated to it today.
Yes. Thank you very much, Chairman.
Order. The committee will go into private session in 3 or 4 minutes, so please be here. In fact, I ought to tell you exactly when. In 4 minutes. 4 minutes. 12:02.